Hey everyone, and welcome to Bright and Early, the podcast for people building early stage startups. I'm your host, Brian Ray. I talk to entrepreneurs, product people, designers, and marketing pros to learn what works, what doesn't, and how can we apply those lessons to our business. My guest today is Tyler Tringas. Tyler is the founder and a general partner at Earnest Capital, where he makes seed stage investments in bootstrappers, indie hackers, makers, and real businesses. He was previously the founder and developer of StoreMapper, a micro SaaS that he grew and eventually sold. Tyler, welcome to the show.
Hey, Brian, thanks for having me.
Totally my pleasure. It's great to meet you. I first came across your work or like what you were up to like 2016, 2017 or so. There was a talk that you gave about building StoreMapper. I think it's like B2B Rocks. Am I remembering that talk right? Okay, yeah. So I came across that that talk and was like, this is killer. So for folks who may not be kind of familiar with your background, can you give us a little bit background on that? How you grew and sold StoreMapper and got to where you are today?
Sure. Yeah. No, I'll try to summarize, a sort of 5 to 7
in a minute and a
year
half or less.
journey. Yeah. No, it's funny that you saw that talk. I mean, that was a really fun experience. Alex, who runs B2B Rocks, invited me to speak, and I was so kind of confused because it's a big B2B SaaS conference. I mean, most of the other panels were like how to raise your Series C financing round and, how to hire your, 15th sales lead, and things like that. And I was like, are you sure you want, he was like, yeah, they're going to love it. And watching people's faces as they kind of came along this journey from, who is this guy and what is he talking about, to like, oh, that's interesting, was pretty funny. But yeah, I mean, the journey it started with, where did it start? I'm going to say, it sort of started with my first foray into startups, which was a sort of total and abject failure in which I learned a lot. But I had a background in clean energy. I was working in sort of the finance sector, so advising investors in clean energy. I had an idea for a solar startup that would kind of be a web application that would help people switch their homes to solar. And I quit my job and I started working on this kind of venture to sort of accelerate a couple of years worth of work there. Basically it just wasn't a sort of typical venture scale business, didn't really fit the model. And I didn't know that. I thought, I have this business idea. It's got code involved. I need more money than I have. So I should probably go pitch VCs and raise a round of venture capital. And, and that's kind of the premise that I started from. And the process went, I would say pretty badly. The business ended up shutting down, and I, basically lost all my money, and I had to basically move to like Southeast Asia, become a digital nomad, and radically cut my cost of living and figure out what I was going to do with my life. And somewhere along the way, I had managed to just through like kind of constant experimentation on the side, I built this little software product that was essentially just a little widget that I was doing some freelance coding on the side for e-commerce companies on Shopify. And they said, hey, could you build us a store locator? And I said, okay, sure, I can do that. I think I know enough kind of, to piece it all together and use some Google Maps and all that. And then I had the idea that, hey, this seems like a common enough product that maybe instead of, just charging an hourly rate for this, I can productize it. And so I bashed together the most minimum viable product you have ever seen in your life. I did the whole first version on a single flight from San Francisco to Buenos Aires.
That's quite the constraint.
Yeah, really, I did. Because I had so many things I was spinning, and I had this idea, and I thought, I think this is a good idea, but I just can't get pulled into a huge long project on it. Mm-hmm. And I was so I was going down to Argentina, where I was actually on one of like my first dates with the woman who's now my wife, which is kind of cool.
Oh, wow.
But yeah, I built the whole first version on the flight, launched it, and lo and behold, sort of 36 hours after writing the first line of code, I had a handful of paying customers from my current and previous clients there. And then, basically it was 5 years of running this business as a sort of distributed, what I call just internet small business. So it wasn't a rocket ship. It was pretty straightforward, predictable, slow and steady growth. Eventually hired a team. They were kind of all around the world, and we ran it as a pretty calm company. And although it kind of grew fairly, let's say slowly, or at least not exponentially, because we just kind of grew it carefully. It was, 5 years later, a very, very profitable business that is the kind of thing that there's plenty of people out there that want to buy, own, and continue to operate. And
Right.
2 years ago, I sold the business.
Right. Were you, and I want to hear more about that, the selling and how that's led to your where you're at right now. Were
Yeah.
you continuing first though? Were you continuing to freelance as you were building up StoreMapper, like after that first 36 hours, or did
Yeah.
you say, oh wow, okay, I've really got something here, and you went all in? How did you manage that?
Yeah, I mean the timeline is a little weird because I launched the MVP version while I was still kind of technically working on the previous startup.
Okay.
And so I was juggling, like my typical schedule was like working 80 hours a week, and it was sort of 50 hours a week trying to get this startup to go somewhere, 15 to 20 hours a week trying to freelance so that I would have some kind of cash flow. And then I'd have like 5 to 10 hours to try to nudge this little product along and build some features and talk to customers. When I shut down the startup and I moved to Thailand briefly, I ramped up my freelancing and ramped up working on StoreMapper, because when I left, I had a pretty massive pile of credit card debt, to be honest, and I needed to dig my way out of that hole pretty fast. And so freelancing at kind of full developer rates while also building up recurring revenue turns out to be a pretty good strategy for that.
Okay.
So,
Nice. Did you ever consider raising money for StoreMapper, or had the experience of trying to raise it for your other startup kind of soured you on the process?
I mean, I definitely never considered it, for the dual reasons that, I had just wasted a huge amount of my life trying to raise money for a business that wasn't a fit for this fairly wide array. I think we probably pitched like 200 to 300 investors over the course of a couple of years.
Yeah.
And so I was definitely very turned off by the idea. And at the same time, I don't think there existed any kind of fund or platform or anything that would have invested in StoreMapper anyway. So no, I didn't consider it. Yeah.
Okay. Well. So speaking of which, you're now on the other side of the table. Can you just tell listeners who may not be familiar with Earnest Capital what it is and what you do?
Yeah, Earnest Capital, we call it sort of funding for bootstrappers, which, yes, I know that's a bit of an oxymoron, but that's our goal, is to be sort of bootstrapper friendly capital.
Yeah,
so
yes.
we make early stage investments in companies that, I just throw a lot of words in there because I feel like a lot of people have a different name that they self-identify with. But if you consider yourself a bootstrapper, an indie hacker, a maker, or something like that, we're probably going to be interesting to you. And we provide a couple of things. We have an investment structure that is sort of collaboratively developed with this community to try to be more aligned with, hey, I want to build the next Basecamp or WildBit. I don't necessarily want to grow exponentially, and I don't necessarily want to sell or IPO. We have a structure that we make investments on that we say, okay, cool, that's great. Whereas almost every VC is going to say, well, sorry, you're not a fit. And then the second thing we have is a community of awesome sort of mentors that are a lot of bootstrapped operators and CEOs of either current or previous companies that are both investors in the fund. So they are then investors in you when we make an investment, and they're on hand through kind of a Slack, Basecamp, Zoom calls, all kinds of stuff like that to
Yeah.
help you work through any problems that a lot of them have been through as well. So.
Yep. Yeah. So you call the financing structure the shared earnings agreement, and you
Mhm.
kind of shorthand it as SEAL. SEAL is how you. So can you give me explain like I'm five? How does a SEAL differ from a convertible note or an equity investment that we're probably more familiar with?
Yeah, so if you're familiar with convertible notes or safes, which is the sort of dominant toolkit that most early stage investors use right now, it's basically I'm going to give you this money, and then later when you go raise your next round, then it's going to convert into equity, right? And it's a sort of function of what is the sort of valuation of that round, and what are the terms we agree on. But in the interim, it's kind of a nothing. Right. It's this sort
Mhm.
of IOU. And then once you raise that round, okay, now I'll convert and I'll have equity. We'll all have equity. And pretty much we'll only see our money back when you sell the business. Right. So it's between the
Yep.
terms and the strategy. The idea is we sit there, we get no money back until you get acquired or you IPO the business. So that's kind of the traditional toolkit. What we've done is it's not fundamentally so different so much as it layers on more options. So we try to keep a lot of that open. So if you raise money from us and then you decide to go and raise venture capital, or maybe not necessarily venture capital, but just another round of equity, we do kind of the same thing. We eventually just convert into equity, and we sort of go from there. But the idea is to sort of keep some of these other avenues open as well. So let's say you want to build, like I said earlier, kind of the next Basecamp or the next Wildbit. You want to build a business that you want to run for 10, 15, 20 years. You want it to be very profitable, but you don't necessarily want to sell it. Well, a lot of traditional investors would say, well, that's not a great outcome for me.
Good for you,
If
but
I
what about
had
me? Yeah.
Yeah, I mean, if I'd put $500,000 on a convertible note into Basecamp, that would not be a great outcome for me. I'd still be sitting around waiting for them to raise a round or sell the business, even though it's an extremely successful business. So basically, what a shared earnings agreement does is it layers in a kind of profit share. So we say, as you, as the founder, start to generate a lot of economic benefits, whether that's, cutting yourselves dividends or paying
Mm-hmm.
yourself a really nice above market, healthy salary, we start to get a percentage of that basically on a quarterly basis. And we get paid that until we reach a sort of capped multiple of our initial investment. So
Okay.
in sort of simple numbers, if we invest $100,000, you maybe give us, let's say, 30% of your founder earnings, and until we get, let's say, 3 or 4x our money back.
Okay. And is that pretty standard what you're doing in your deals right now is about 3 to 4x?
It varies quite a lot, to be
Okay.
honest,
Okay.
because we're seeing interest from companies that are as early as they just launched the product a few months ago. They've got very early revenue, to companies that are doing $1 million a year in revenue.
Yeah.
And so we're trying.
Yeah.
Obviously, you would not do the same terms for those two companies. So
That's right.
it really does vary on a
Okay.
substantially on a deal by deal basis. So.
Okay. And so just so if I'm understanding this right, so then um I take 200 grand from Ernest, and then
Mhm.
a year goes by where I'm not taking any founders earnings, or I'm not paying myself anything above market rate. I'm not paying anything back to Ernest yet. Is that right?
Correct. Yeah, it's
Okay.
it's not like debt in the sense that there's a repayment schedule. It's
Okay.
depends on the outcomes of the business, and
Okay.
it's always a function of what the economic benefits going to the founder. We get a percentage of that.
Okay.
That's all.
And And so then when it starts to grow and I do start, pulling a little bit of money off of the table for myself in exchange for all of that hard work, in exchange for Earnest taking off some of the risk early on, I'm going to send 30% of that your direction.
Exactly.
Okay.
Yeah.
So let's say we had agreed, and just to carry it all the way through, we had agreed that I'm going to pay you back for X. And
Mhm.
so after a couple of years, I've gotten to, what did I say originally? 200,000. So I've paid you back that 200 plus another 200. And now an acquirer comes in out of nowhere and says, "Hey, we love your business. We want to give you, you know, $8 million for it, whatever. It doesn't matter." You're
Mhm.
at that point, you're fine with that as well, because you are going to get a percentage of the purchase price, right? Like you have
Yes.
an upside there.
Mhm.
Okay, all right.
Yeah,
Is that
exactly.
Yeah? So I guess one of the things I've wondered about, um, is, I mean, the VC model, works as it may have, it works because from time to time one company in the fund just knocks it out of the park and earns back the fund. Is there any part of your thinking that most of your companies will just operate as a profitable business, novel concept, and you'll earn back that 3 to 5x, or even variable, you said, but you'll earn that back. But from time to time, there might actually be an outlier. Is that part of your thinking at all?
For sure it is. Yeah.
Yeah.
I mean, I think there's nothing in our model that prohibits us from backing the next Atlassian or something like
Right.
that
Right.
bootstraps effectively their way all the way to a sort of massive valuation.
IPO. Yeah.
And
Yes.
yeah, and so we think about it, but it's not something that we optimize for. I mean, one of the things that we kind of question, and I don't know how much of your audience will care about this because it's kind of getting into the investor side of things, but one of the basic ideas we question is there's this sort of dogma that there's this kind of iron law of startup physics, which is most of your attempts at starting a company are going to fail. Some people say 90%, some people say 70%, but a lot of people think it's a fixed number that says most of them are going to fail. So the only way to make it work is for the ones that don't fail to be as big as possible, right?
Hmm.
And that's the basic model of all of venture capital. We kind of see it as something that actually there's an interplay back and forth between ratcheting up both the risk and the reward, right? So if I write you a check and then I say, look, here's the milestones you're going to need to hit to raise your Series A in 12 months. You need to grow 7% every single week. You need to double, triple your business, all of these kind of things. Then you're going to take a lot more risk. You're going to maybe hire more aggressively. You're going to spend more money on customer acquisition. You're going to do a lot of this stuff that maybe it's going to increase your chance of being like a unicorn, but
Hmm.
it's also, in my opinion, going to be increasing your chance of also, burning down the business, right? And that's
Right.
okay. I mean, you can choose where you want to be on the risk reward kind of profile, but our premise is, hey, if you just grow more sustainably, you hire more slowly, you focus on organic free customer acquisition, those kinds of strategies, you maybe are going to grow slowly or less fast than you otherwise would have, but you're also just less likely to just outright fail, right? And that's our basic premise.
Yeah. The thing that's so attractive about what you're doing, um, Tiny Seed and NDVC as well, but it seems like from the outset, there's tighter alignment between the founder's outcome and your outcome. So if I get funding from a traditional VC firm who genuinely has my best interest at heart, it isn't pushing me too hard, and any of these other things that can happen, um, that at the end of the day, if in a couple of years someone comes along and says we want to buy the business from you for $5 million, and that puts $2 million in my pocket as the founder, well, that's life changing. Whereas
Yeah.
the the general partners of that fund are like not even going to notice.
Mm-hmm.
And
Yeah.
so yeah, I guess, can you talk a little bit about that? How that, have you seen that alignment between interests already playing out, or are there aspects of it where you feel like maybe it keeps you and your network from pushing founders maybe harder than they want to go? Talk about both sides of that coin.
Yeah, absolutely. I mean, I think you hit the nail on the head in the sense that, that this was my direct experience was, I sold the business for a number that, would not even register in a typical VC portfolio, but was totally
Right.
life-changing for me.
Exactly.
And in many cases, between a mixture of the structure and the strategy and just the way that, your investor is gonna kind of advise you, they really go to great lengths to say, if you raise a little bit of money early on and you get an opportunity to sell the business for 5 million, 10 million, $15 million, they're going to immediately be like, well, I've got this great Series A investor. Let me get you like 3 term sheets, or maybe they're even on the board and they literally have a right to block the sale because they invested at a $15 million valuation. And so they're just going to get their money back. And so, they actually have, let's say, rights to even block that kind of a sale. But in general, there's just all kinds of misalignment, both at a structural level and at just a strategy, like how do they run their business level. And one of our principal, kind of guiding principles here is that we want to be aligned with the founders in almost every possible scenario. So it's one of the reasons why, I didn't want to be sitting on boards and making decisions and having even the ability to, fire the founders or any of that stuff. So I said, okay, well, how can I do that and feel comfortable with that? The main way is that from the get-go, we think through every one of these outcomes and say, how can we, if the founder decides this is the best outcome for the business, how can we just be set up to say, okay, we agree, great.
Yeah.
And that flows through every aspect of how we set our terms and how we structure our investments to how we advise them. And yeah, I mean, I think that's something that, a lot of founders are looking for, because those are seriously life-changing outcomes that basically get taken off the table by other kinds of early stage capital.
Yeah. Yeah. I'm curious what you've seen in your portfolio companies so far, because like founders typically are seeking funding to solve, one of two problems: either financial debt, because they've maxed out their credit cards trying to get their product to the market, or
Yeah.
time debt, because they're like paying the bills by doing freelancing and consulting, and then only able to spend a few hours a week on the thing that's actually more likely to result in financial independence, like the growth of a scalable asset. And so
Yeah.
so financial debt and time debt. What advice do you have for founders who find themselves in either of those situations?
Well, I mean, the first thing I always say is that I'm not in the business of talking people out of bootstrapping, right? I mean, I
Okay.
think that, there are many situations where, you should probably just continue bootstrapping the business. Maybe you haven't quite found, that kind of product market fit. Maybe the product is not the one that, that you should actually be spending your time on. Maybe you haven't quite found the kind of growth engine, that first one that's going to get you, kind of repeatable customers, and maybe it makes sense to just continue kind of, bootstrapping and making your way along. And you don't actually need to raise capital really ever. There's always a way to do it without capital.
Okay.
But you know, to answer your actual question, I would say in our portfolio, what we've seen is a lot of the second one. So it's primarily basically founders who've got something that's doing well on the side, and it's starting to grow, and they're working on it nights and weekends. And you just kind of reach that inflection point where you've got a bunch of customers, so you've got support requests and feature requests, and you're trying to sort of spin all the plates of the business, but you're not really making enough money to go full time or to make that first kind of hire to help offload some of that bandwidth.
Yeah.
And that's one area where we're super comfortable coming in, and we feel like we add a ton of value. So I would say, we've made 10 investments so far since we launched in February. So we're doing almost 2 a month. And I would say probably 6 or so of those were more or less some variation of that scenario where,
Okay.
basically they raise the capital to be able to go full time with the idea of, before the money gets spent, that they're kind of back to, that they
Yeah.
get to break even.
They have existing traction. They just need to be able to go in on it full time so that they can get to close to a baseline salary on the runway that you're giving them. Is
Yes,
that a
exactly.
summary? Okay. All right.
Yeah, and I would say that's both what we've seen a majority of the cases, and what I originally sort of designed Earnest to be really
Yeah.
targeted for, because I saw it as the most acute need where people genuinely don't have an option there. It's like you just have to muddle through right now. And so that's what we designed it for. But what has turned out to be the case is that even as companies mature, they both have a need for the capital, but they also really, really value the other aspects of working with Earnest. So working with a cohort of other entrepreneurs to
Right.
collectively problem solve, working with a ton of amazing mentors that can help
Mhm.
you, hire the right people, see around corners, solve problems, all that sort of stuff. And so we're also making investments in companies that are significantly further along, that have already been working on it full time. Maybe they have a small team, but they want to make a big hire, a lead engineer, a head of marketing, that kind of thing, where you don't really want to just sit there and wait for your MRR to creep up enough to make that hire straight out of your cash flow, and you also just value all that other stuff.
Mhm.
And so we've seen, I think at this point, probably 30-40% of the companies are more in that category.
Okay. Yeah, your Ernest's list of mentors is extremely impressive. Like you've got some superstars in there. And is it ever a like what's the right way to ask this? Is it ever a problem for some of your portfolio founders to get a little bit like starstruck and not push back against the advice of like DHH and just go along with it? Is that something you'll ever have to address?
So far we haven't really had to. I mean, I think I tackled it pretty head on from both
Yeah.
directions. I mean, it was something that we were concerned about. I think maybe overly concerned about at the beginning.
Okay.
But all of the mentors, I wrote this post called Earnest Mentorship, which kind of summarized a talk slash series of emails that I sent to all of them, kind of really articulating that, like, hey, your job is not to just kind of sit back and pontificate. It's not to armchair quarterback how people should run their business.
Mhm.
Your job is to actually help problem solve. It's to ask good questions. It's not to just give your knee jerk, answer to this question. Is to say, help them think through it and come to their own conclusions and stuff like that. And I think a lot of mentors have really responded to that, and that's resonated with them.
Yeah.
And then on the founder side, we just constantly reiterate from the get-go that, hey, this is your business. Everything here this is an all-you-can-eat buffet of, interesting ways to get advice, get help, that kind of stuff. But at the end of the day, like, it's your company, you have total control over it, and you have to be the one to make the decisions. So,
Yeah.
so far so good.
All right. Hey, listeners. We'll get back to the interview in just a second, but this is a great time to pause and let you know that Bright and Early is brought to you by Transistor.fm. Transistor offers you professional podcast hosting and analytics. They host this very podcast, and listen, y'all, it could not be any easier. Product is ridiculously easy to use. If you've got a question, Justin and John, the guys behind the software, are super responsive. I've needed to reach out a time or two for some help. They were all over it. So if you're thinking about starting a podcast for your business, just pop on over to transistor.fm and let them know that Brian sent you. It's the other thing I think about your story that's kind of interesting is that you personally experienced like the slog of personal debt as a bootstrapper. I mean, you've shared publicly before, like you were, and a bit before here. You were under a significant amount of personal credit card debt trying to build StoreMapper. So you've experienced that, and now as like raising for Earnest, like you've done the fundraising tour, which is similar to what founders of startups seeking VC investment, have to do, albeit slightly different context. But you haven't had the experience of getting to be the entrepreneur with some traction, getting funding from an institution like Earnest or India or any of those others. I'm just kind of curious, like what have your experiences taught you about the challenges of getting a new venture off the ground, and how have you brought those lessons into the way you've structured Earnest?
Well, one thing I'll say is that like I'm incredibly jealous of our portfolio companies right now.
Yeah.
I mean, it's the most energizing time of my day. Every Monday we do like an all founders weekly call, and then there's constant activity in Slack and Basecamp. We sort of alternate between the two for synchronous kind of chit chatting, and then longer kind of asynchronous threads go in Basecamp, and so there's a lot of activity. And man, it's incredible. Like sometimes I think about like I tweeted a couple of these things that I could share. It's like one of our founders was really struggling with getting an integration to an API at a very large tech company. And he was just kind of grappling with it. And one of the mentors jumps in and says, well, hey, I actually lead an engineering team on this product. Let me see if I can dig in and solve this for you. I was like, oh my God. I wish I had, that kind of
the network
access when I was
so
building
powerful. Yeah.
Yeah. But it's funny. It's not funny. It's interesting that, you mentioned that, I have talked about how I had a ton of credit card debt. And when you go around now and you talk to entrepreneurs who are kind of famous bootstrappers, a lot of the folks that are in our mentor community, a lot of folks that aren't, and you talk to them about those early days, you often hear pretty similar stories. I would say, it's sort of a very small percentage of people just sort of casually cruise into bootstrapping. A good majority have some sort of, heinous story like mine involving, massive credit card debt, moving back in with your parents, selling your house and moving into a car, all that kind of stuff is super common. Shockingly so. And then the other side of the coin, what you often don't hear are people who are, famous for bootstrapping, who, frankly didn't necessarily fully bootstrap. They have they inherited a big chunk of money, or they had a spouse who had a very high paying white collar job that paid their bills while they built the company. And so it's basically, it all boils down to like, it's really tough early on. There's this really big hurdle, both, on every aspect, just in terms of getting customers, building the product, all that sort of stuff, but also the money side of the equation is just a huge hurdle early on. The kind of stuff that the amount of money that some of these companies would probably spend on their, on their annual retreat now, was just an insurmountable amount of money for them in the early stages. And so that's one of the things that, really drove me to want to build this, is to say, hey, look, once you get over that hump, you can grow a company really, really well from customer revenue and all that sort of stuff. But then at those early stages, it's really important to get a boost there. I think I a little bit lost track of the question, but
oh, no, that was good. Thanks so much. What are there any trends that you're seeing, either in your current batch of companies that you've invested in, or just any trends in general that you're seeing from applications or things that you're keeping kind of a pulse on that other startups ought to be thinking about, other founders can be thinking about?
Yeah, I think there's two. So one is just about kind of, how folks are running their companies. And it's not a rule that the companies that we invest in have to be remote companies. But we are remote. I'm here in Rio de Janeiro right now, and our group of mentors is very diffuse and remote, as are the companies that we back. And just by coincidence, I think probably eight out of 10 are distributed, remote teams. And there's been a really interesting and good discussion about how you need to be very cognizant in how you build your company, who you hire, and what processes you build if you're going to run a distributed team versus some of the just cultural operating systems that you inherit from being a person who knows how work is done in the modern economy in a non-distributed office. So there's been a really active discussion in our community around what things you need to do differently or really think more about that just kind of work in a co-located team. Things like how to make sure you're building culture, or things like how to foster tighter relationships with your team. One interesting one was how to hire. So a couple of folks who have a lot of experience there kind of talked about how when you're distributed and maybe you're going to be more asynchronous, clear writing and concise communication is just so much more important. That one of the things that we recommended, as several of our founders are making their first hires or are going out there and thinking a lot about hiring, is that we have this thing that we have taken from the kind of co-located office world that says, hey, when you're hiring someone, you look at their application and then you call them into the office and you have a face-to-face interview. And that's kind of migrated to, in a distributed team, you look at the application and then you hop on Zoom, right? Or you get a Skype call and you do a face-to-face video chat. And that's actually often the tool that you're going to use the least to communicate with, right? Video chat. And so one thing that we've advised a lot of them to experiment with is, hey, run your interview process using Slack, using Basecamp, using Asana, using GitHub issues, using the tools that you're actually going to communicate with. Do your first layer of interviews just using those tools. And then, maybe later, before you make a firm offer, you want to have a face-to-face chat. But before you get biased with someone who's works really well, face to face, but actually writes these, novellas of emails, that are just, absolutely unreadable. And you realize, oh my gosh, I can't work with this person. Use those tools. And so I think that's really interesting, but with the broader idea of, thinking a lot about how to do remote work. And the second thing that's been really interesting is a lot shorter, which is just, I've written a good amount about sort of how to find and vet just like business ideas, in particular micro SaaS, but just in general, think about it a lot. And one of the common refrains you hear in the literature blog posts about this is to scratch your own itch. And I think that is good advice in the sense that it is easier to build a business where you're scratching your own itch. You don't have to constantly do market testing. You have an intuitive understanding of, what the customer needs.
Yeah.
Yes, exactly. But you need to have more interesting itches these days. Like if you are someone who is a graphic designer at a big tech company in San Francisco and you like to, drink pour over coffee and, go to the movies, you just don't have very interesting itches. Like everybody has already tramped all over all those itches and there's a million products for everything. So what we're seeing pretty often in companies that I'm really liking to invest in right now that are really strong founders with really interesting businesses are people that are coming from a different perspective. Either they had a different industry that they were working in that they now want to build software for, or they had something about their lifestyle that was just very unique and they've built a product for that. And, I think that's a really great way to build a business, but it sort of starts further down the line from what business should I build to just broadening the scope of your life and doing more interesting things. So you kind of are very early stage,
Yeah. So you have a company that their business is to render end credits for feature films.
Yeah. Yeah,
That
that's
is
a
an
great one.
okay. That's an interesting itch. It's just a fascinating thing the way you point that out, like that so many like maybe the maker space is matured enough now that the number of this is not true totally, but like the number of problems to be solved in running a software business are getting much harder to find, but taking that approach to different industries, it kind of sounds like what you're describing.
Yeah, absolutely. I mean,
Yeah.
certainly a more specific version of this is, I think the typical stack of running a software business or running a, let's say, just technology business is getting pretty full of
Yeah.
generalized products. So
Yes.
in terms of a CMS to host your site, and a CRM to manage your customers, and an email marketing tool to talk to them, and all that sort of stuff. I mean, there's tons of really good kind of
Yeah.
horizontal competitors there. But if you're going to go and build email marketing but for dentists, right, or a CRM for waste treatment companies and things like that, and you can actually go and build a whole bunch of specific features for that industry, and you're going to build it 10 times faster than the kind of broad-based incumbents, because frameworks have developed so much, and you have all the advantages of everything that's been built in technology today. And so if you only get to 2,000 customers that pay you $200 a month, that's going to be an incredible business if you don't raise that much capital.
Yeah. Yes.
There's so many opportunities out there that I think are much more about not, let's say, marketing automation like this, but marketing automation for these people.
Yeah.
And I think that's a really, that's a thread that a lot of entrepreneurs should be pulling.
Hmm. So tying that interesting itches back to the first thing you mentioned of remote work, remote companies, like that's a growing market. Justin Jackson's been talking about this a whole lot recently. Like so much of your product success is going to come down to the market that you're in and riding a growing wave. Um, is there a problem that you're seeing recur over and over again around, like you kind of mentioned a few of them, but is there like a company that you're waiting to show up at Earnest with, hey, we are doing X for remote companies?
Yeah,
I'm
I mean,
actually not, I'm not gonna publish your answer. No, I'm joking. Go ahead. I'm gonna just jot
no,
it
I
down
mean,
here.
I wrote an entire blog post on the Earnest Capital website that was a request for startups, where I just went through a litany of problems specifically around remote tools for remote teams. And so I think there's a ton of interesting opportunities there, around how to
Mhm.
do long-term career management, how to do short-term employee engagement, how to do like basic scheduling across time zones, and all that sort of stuff. I mean, the challenges we face right now, just of scheduling our regular one-on-ones and all of our group meetings across time zones, is still not even close to a solved problem. And I think there's a ton of good opportunities there that I kind of documented a lot of them. And I think one of my goals with Earnest, it's very much a sort of side project relative to everything else we're trying to do, but it's to be the best kind of beta testing ground for remote tools for remote teams. Because between our companies and the companies that our mentors run, we've got something like 30 of varying sizes remote teams that are a part of Earnest, and then Earnest itself is a kind of meta remote team. And so if you want to get a great group of folks to just kind of really help you refine and iterate a beta that fits this category, we want to be really helpful there. So we've actually like invited a couple of folks who are building those remote tools to basically invite the whole community as beta testers, and then hop into our group Slack and just be on hand to get beta feedback and all that sort of stuff. And
Yeah.
this is for companies that we haven't even necessarily invested in. We just want to kind of help, I don't know, seed the ground with new ideas here,
Good
because
stuff.
it's yeah.
Cool. Listeners, I'll link to that, but it's also super easy to find. Just Google remote tools for remote teams, Earnest, and it's the very first one. Tyler, is there anything about the whole VC world that has just surprised you the most?
Yeah.
Pick one.
There's quite a few. I actually coincidentally, I just tweeted a list of weird things that I've sort of discovered. I guess, I mean, so many things are strange in this world. I guess one of them that I think is a little bit bizarre is how few investors apparently actually lead investments. So even though there's hundreds and hundreds of venture funds out there, I saw, and I can't remember the source on this, but there was an analysis of cross-referencing who actually kind of led the round, and it turned out to be like a vanishingly small number of firms. It was like 20 or 25 of them were the only ones who were the actual decision makers, and then everybody else will say, great company, I'm in for 100K, assuming you get a lead investor, right? So it's a contingent offer investment.
Okay.
And this is very bizarre to me. It never even occurred to me to sort of build a fund and then not actually be the one to sort of make investments, to actually decide what companies we're going to back. So that's been, I guess, eye-opening. And yeah, there's just so much other weirdness here. But I don't know how much your audience is going to care about how weird the world of venture is. So I'll leave it there.
Okay, at least to a degree. Okay, I guess so. The final thing I want to just get your take on. You've talked about growing slowly, running a calm company, but you've also experienced you've got your scars. Like, you've done your fair amount of sacrifice. And I heard this quote recently, and it says, "Anyone who says you don't have to sacrifice anything to grow a company is naive. Anyone who says you have to sacrifice everything is dangerous." What do you make of that?
Yeah, I mean, I completely agree with that. I think.
Are there sacrifices that you made along the way that you I guess either with some foresight, or that with just straight up advice to anyone listening? Absolutely do not do this, even if it's what it takes to grow the company.
I don't know, because I will say one of the things that I think gets people in trouble when they run a company is their own personal kind of burn rate, how much money they need. Mm-hmm. That's what I think drives a lot of people to start to cut corners, to do slightly unethical things. And even though, look, I was very lucky. I didn't have any financial dependence. My family, my parents, everybody was all self-sufficient. And I didn't have any kids. I didn't have a spouse who depended on me. I didn't have a mortgage. So I was able to, when I needed, even though I had a mountain of credit card debt, I was able to, cut my cost of living to, hundreds of dollars per month. And so, I was able to sort of take my time. And I think where people get into real trouble is their business starts to do pretty well, and they start to ratchet up their lifestyle, and all of a sudden their kind of personal burn rate gets way out of hand. And that's where people start to cut corners. But I mean, I think in terms of sacrifices in your business, if you do it right, you can view them as an investment, right? So certainly there were times, when I was running my business where, I was working, a lot, right? I was working, sort of 30 days in a row without a break. I was working 60, 70 hour work weeks, and getting Earnest off the ground as well. This past Thanksgiving, we were right in the middle of launching. We launched the fund in August. And I remember this Thanksgiving, I was visiting, my wife's family, and we had a huge Thanksgiving dinner planned, and there tons of family had flown in, and I basically got up at like 4 a.m. and drove myself to a Starbucks to go and answer emails and send pitches, and because it was a bunch of European investors and they didn't care it was Thanksgiving, so I was basically just having to crank out emails so that I could get back a little bit bleary-eyed but still have some family time. And I think those are sacrifices, yes, but if you're doing them right, they're an investment with, with a payoff. And so I think it's, making sure that you're not kind of just doing pure hustle porn. You're
Mm-hmm.
doing something that you feel like is going to have a payoff in terms of letting you recoup your time, recoup your flexibility, have more impact on the world, that kind of thing.
How can our listeners find and follow you online, Tyler?
The easiest way is to follow me on Twitter. I'm Tyler Tringas. That's Tringas. And we are also Earnest Capital. So EARN, like Earnest. And both of those are tylertringas.com and earnestcapital.com. Those are the best ways to read what we write.
My guest today has been Tyler Tringas. Tyler, I really, really enjoyed this interview. Thanks so much for coming on and chatting with me today.
Yeah, likewise. I really enjoyed this too. Thanks so much.
Okay, let's do some closing thoughts here. First thing, I just love that first version of Store Mapper was built on a plane. That's just really fun to me. The idea of setting a preposterous time constraint and seeing what you end up with at the end of it. I just think that's fantastic. Overall, in general, I just love that Earnest Capital and everything Tyler's trying to do there, that it exists, that it along with in a tiny seed and indie VC, just introducing, I think, the concept to the bootstrapped circles, indie maker circles, to kind of add some nuance to the idea of taking investment, taking funding, that it is not in and of itself inherently bad. That taking it under bad terms is bad. Taking it when there's not a good alignment between outcomes is bad. Having access to capital to run a business is not by definition a bad thing, and I just think there's gotten to be a bit too much dogma built up in our circles around that. I'm probably super biased in the direction of traditional VC investments, because at a previous startup we had phenomenal investors, who just like super traditional VC model, but we're just fantastic people. If we needed a connection, they could put us in touch with somebody. We've got a our site has some couple 100 million URLs in Google. Hey, how do we think through SEO? Well, let us put you in touch with Rand Fishkin, and then you guys hop on a plane and go sit down with him and his team and talk about it. Like, that sort of value that you get through those networks is fantastic. Anyway, so I don't know. I totally get, and I know that there are many, many, many horrible stories about companies taking traditional VC investment and it going terribly wrong. I know that that's true. We also just need to acknowledge equally that there are many self-funded founders and entrepreneurs who are personally under large amounts of credit card debt. That is also no good. And so it's great that there are these new options coming onto the scene that's somewhere in between. That's bootstrapper friendly capital, bootstrapper friendly investments, funding. That is so great, because for far too long, funding for bootstrappers has been an oxymoron, and it just doesn't need to be. So I'm a huge fan of Earnest and the shared earnings agreement seal that he's talking about. The way that it's structured, the alignment is solid. I am a fan. I think just to kind of torque on it just a little bit. One example of where I think, one example of a bit too unfair a perspective over investment in startups, or traditional investment, is a bit off. There's this tweet that got a whole lot of play last week And it says, "Today is YC's demo day, where founders try their hardest to give away control of their company. Let's celebrate bootstrapped and self-funded founders with our own demo day. Reply with description, MRR, and link." That is super, super cool. It got a ton of impressions. Got shared all over the place. Hopefully, many of the businesses who were listed in that thread got some visits and saw a little bump. That's awesome. I am all for celebrating bootstrapped and self-funded founders. What's unfair about that tweet is that not a single company who raised money at YC's demo day gave away control of their company. What they did do was to sell a percentage of their equity in exchange for having the ability to work on that company full time. I mean, that's the trade-off, and that's not by definition bad. An equally unfair, tweet from the other side could say, "Let's celebrate all of the self-funded founders who are, wringing their hands and pulling their hair out, trying to find time to both pay the bills and work on their passion project, while taking on mountains of credit card debt and putting themselves and their family personally at stake, for loans or whatever." It's neither of those things tell the whole story. And so I'm glad that this is happening. I wish that there were, I hope eventually there will be many, many, many hundreds of Earnests, and that Tyler will be able to do more than, two investments per month. It is a great, great thing to have this option. Because, I mean, if we're, when you are starting a software company, there's no, you can't take an asset to put up for collateral to your local bank to get a line of credit, or to get a loan. You're gonna have some sort of personal guarantee of your house or something like that. That might be right for your situation, but that's the great thing about that's one tremendous benefit of traditional venture capital, is that there's not a personal guarantee. We are sharing some risk here. There's some likelihood that this thing isn't going to work out. That's part of your model, venture capitalist. All good. As the entrepreneur, I'll do my best to make sure that doesn't happen. There's just, anyway. Yeah, I think that's all I want to say, is that I like arguments on both sides of this position. Highly recommend you check out the request for startups, remote tools for remote teams post. Tyler's got some interesting ideas in there. I'll also remember to link up to Justin's I think he's got a tweet, a thread somewhere, maybe even a post, just on the idea of that so much of your success will depend a bit on the growth of the market that you're in. And so the future of work is more remote than it is today. That's probably a growing market. And so he's got some interesting thoughts in there. If there's something that resonates with you personally that then connects to remote work, I think that there's something fascinating there. And as always, let me know what you think. You can find me on Twitter. I am bray. That is B as in Bradbury, R as in rolling, H as in Hugo, E as in Emerson, and A as in Austin. Find show notes at brightenearlypodcast.com, and I will talk to you next week.